All right. So I'm going to explain to you guys how I turned that 25,000 into 728,000. It's going to be all about the option selling strategies I used. Mostly what I used is credit spreads and iron condors. So in this whole entire video, it's just going to be strictly about that. And then at the end, I'm going to talk about automated trading as well. So you guys can get a piece of that and see if that fits for you. But this whole thing is for education. I want everyone to be able to see how this strategy works and be able to utilize it for themselves. I know a lot of people have issues with actually just buying long and short contracts. So just buying a put or buying a call, and that, usually 90%, or that's the statistic at least, 90% of the people do not succeed. I feel like this strategy is so overlooked because the profit compared to the risk, even though I would never personally risk that amount, is where people get a little, off the tracks and kind of shy away from it. So for example, if I'm doing $1,000 of risk and my profit's only 80 bucks, people shy away from that. Whereas the consistency on the strategy is pretty high, especially the way I do it very conservatively. So I'm looking, pretty far out, usually a 94, 95% success rate. And of course, you're gonna have losers, and I do have losers. I had one last week. Um, but since I started this 3,000 challenge, and I know a couple of people have seen it, whether you're in, a couple of discords that I'm in, um, I've lost 2 trades since we started it in over a month. So again, there's going to be losers. Nothing is ever 100%. And if anyone ever tells you there's a strategy like that, run far away. Okay. That is for sure. Um, Again, I do this conservatively. That's why the success rate is a lot higher. But anything with option selling usually is a better win rate because you're making money on the premium burning. You're making money on the premiums going to zero. So, data burn is in your favor, and you don't usually need a true direction to make money. Whereas if you're buying a long call, let's say if you're long QQQ 491 calls, and as you could see, and after hours, let's just say it's going down, you'd be losing. Now, if you were selling a 485 put and it's the end of the day, you want to make money, something like that. We're gonna go all into this right now. I'm gonna make it as simple as possible. And because when I started doing this and when I went online, they give you all this bullshit that I feel like you don't need to understand. They try to explain it in the most hardest way possible with all these extra terms. I'm going to give you guys the easiest way, in my opinion, that it should be explained. So I'm going to go into by the way, so let's start off with the basics. You're going to need a margin account. You cannot trade spreads, any sort of spread, unless you're selling just regular puts. Well, actually, sorry, let me take that back. You need a margin account, okay? You're going to need level 3 options to do credit spreads and or iron condors. So margin account and level 3. And then you're going to need a minimum of $2,000 to even get the margin account. And I believe that is set for every single broker now. I know it wasn't truly a rule in the past for some brokers. I believe it's set for every single broker. So $2,000, level 3 options trading, and a margin account is what you're going to need to even to start this process and start this strategy. So I'm going to dive in and kind of give an example of what I did today. So today, let me pull this up. I'll start with the chart basis, and then I'll get into how to place the order, how it works, and go from there. So today, we have a great example. We got into QQQ put spread. Put spread meaning you want the price to stay above your sold contract. You want it to stay above a certain area to make profit at the end of the day. For me, I am always usually doing QQQ same day or next day contracts for this, for spreads in general. This is just a strategy in a way that I've done it personally that has worked extremely well for me. And again, like I said, I have my losses. I come back from them. You just got to move on. It's just like any other trading strategy. You live, you learn, you grow from it. So with this example today, we were starting to break down on Qs. Okay. Now, going after yesterday, we could see that we had a red day, and this is a daily candle now. So I'm on the daily chart. You can see we had a red day. I know when you put on EMAs, blah, blah, blah. I like to have these on. When you put on EMAs, we had the 21 EMA at 486, just about, okay? So my thought process when we started to dip today was I don't see us breaking. If we do, go to 486, that's fine, okay? I was looking for further out, so I'm always looking for contracts, and I'm going to show you this in just a few moments, but I'm always looking for contracts that are possibly that it shows is a 90% plus success rate. So I'm always looking usually around 1.5 to 2% out of the money. Um, because as we all know, Qs can move. As we all know, in general, the market can move. Okay. So 2% move would be, over $8 on QQQ. We just had a red day yesterday. Yes, we could obviously, flare up and have another big red day. But after we started to see, some bottoming here, right around that 10 o'clock mark, I started to look to possibly get a spread. So I sold a 483 put and I bought a 481 put. So now let me explain how that works. When you're selling the 483 put, let me go into here and show you guys exactly so you can see a visual of this. I'm more of a visual learner, so it kind of works a little bit better, especially for me. Okay, so I'm going to use tomorrow's contracts because I don't even think I could go to today's. Yeah, it's already gone. Okay, so let's say I am selling that 483 put. Okay, so you could see here the chance of profit, and you could see this on any broker. This is just something I look at personally. It's not something I fully follow, but I am always taking, something over 89 to 90% chance of profit. So I did the 483 put today. It says for tomorrow, it has a 92.8%, chance of profitability. Obviously, we have some data in the morning. Let's just throw that out of the way. Okay, so you would click this, okay, and then you'd switch over. So you're selling the higher strike when you're in a put spread. You're selling the higher strike. You don't want the price to be below 483 by the end of the day. And I bought the lower strike. So now what this means is there's obviously a $2 strike difference. So for every contract I am opening for this spread, it is going to be $200 per contract at risk. Okay. And as you can see here, so the premium of the sold strike is 0.17. The premium of the bought strike is 0.11. The math of that, obviously, 17 minus 11 is 6 cents or $6 per contract. So $200 per contract to open the position and $6 per contract would be the profit. Now, does that sound crazy? Yes. Would I ever let myself lose $200? No. Would I ever let myself lose $100? No. And I'll go into the stop loss here in a second on how I utilize that. My dog, damn. You can see here, and it shows you on Robinhood, for example. QQQ price at expiration, as long as it's above that 483, as long as it's above that sold strike, you're gonna make profit. Okay. If QQQ rises, let's say QQQ is 490.50 right now. If it goes to 492, the theta burn is going to be even better for your contract, and you're going to be, up percent, at that time. If QQQ falls and goes down, let's say it goes to 488, you're going to be down in the position currently. But it doesn't mean you're going to possibly lose on that position. You still have another $5 to go. So here's what I do personally, and this is what has worked for me. I used to have a higher stop loss, and I'll talk about that right now. I used to do a 250% stop loss. So what that means, because people hear those numbers and they go crazy. How are you going to risk 250%? What that means is I am risking 250% of what the profit number is. Okay. So let's say, so 200% is $14. Okay. 100% would be $7. 250% would be $17, $18 because it's, the 350. Let's just do 200% flat because that is my new stop loss. I lowered my stop loss from 250% to 200%. And the reason why I had this 200% stop loss is one, capital preservation. This is going to be key in any strategy you do in trading, no matter it's spreads, no matter it's shares, no matter it's options, just long and short with puts and calls. Everything is about capital preservation. Without capital preservation, you can't trade. If you lose your money, how are you gonna make it back? Or how are you gonna get into that next trade? You have to preserve your capital. So with that 200%, okay, I am risking $14. Okay. So if I get one contract and I'm gonna make $7 in profit, I am risking $14. So I'm risking 200% of what I was supposed to make in profit. And the reason why I do this is because I consistently size every single trade. So if I was to lose on a trade, I would make it back in 2 trades or 3 trades at most. But for example, that is exactly why I use that stop loss. Okay. So if the profit is 10 cents, let's say the total credit is 10 cents. Okay. And I'll do it right here. So it makes it easier. Oops. What just happened? Ah, that's why. Okay. Wants me to do these. Okay. Wait, hold on. Let me just refresh this. Okay. So if you are doing the same thing that we were just doing, I'll just do the next day contracts. Let's just say it's 10 cents. I was trying to make it 10, an even number. Let's say it's 10 cents. Okay. And I buy 10 contracts. So my profit is $100. Okay. If it is that $2 wide. So if my profit's $100 and I have the $2 wide strike, so I'm selling a 483 put and I'm buying a 481 put. So it's $200 per contract to get in. And I buy 10 contracts. That's $2,000 at risk collateral. And I'm set to make $100. Okay. So 2,000 totally at risk, 100 to make in profit. So I wouldn't risk more than the $200. Okay. I have a $100 profit. I would get stopped out at $200. That's it. If I lose, I make it back in the next 2 to 3 trades and go from there. The consistency on the strategy is really high, like I said, and that is why I went with this stop loss. And it has worked for years. I've been trading spreads for 4 years, going on 5. Initially, I was at 300% stop loss. Then I went to 250% stop loss, and I found the sweet spot at that 200% mark. So that is where I've stuck with it. And again, people hear 200% stop loss, they go crazy. People hear $100 with 2,000 risk, they go crazy. Again, I would never let it happen. In 5 years, I'd never let it happen. I've traded this in COVID with that volatility. I traded this in so many different events. It has not happened. And of course, listen, anything could happen. But I'm trading this live intraday. It has not happened. I always have my I always have my stop set, and I get stopped out. And that is how it works. So I'm looking for, again, 90% chance of profit plus, and I'm looking usually 1.5 to 2% out of the money. And that's for me conservatively. Some people like to do it even tighter. If price is 490, they like to do 486, 487, sell that. Listen, if you like that, that's up to you. I used to do that when I first started. It is much riskier. And I like my conservative way because I've just been continuously compounding, loss, compounding. And then I'm using that money to outsource into other things like dividends, real estate, and so on from there. So now that we talked about that, we got the stop loss out of the way. Let's also now go into a call side. So call side, if you're selling a call credit spread, now you want the price to stay under a certain level to make profit. So let's say QQQ is 490. Tomorrow, we don't expect it to get above 500. Okay. Again, that's that 2% mark. You're over that 2% mark at that point. Um, and let's do a $1 strike wide. Okay. And we did the $2 strike wide. Let's do the $1 strike wide. So you're selling a $500 call. You click this, you switch over to buy, and you just click the 501. You're selling a $500 call, meaning you expect Qs to stay under $500 tomorrow, and you're buying a $501 call. Now, the reason obviously why that I didn't really go into this on the other end, but the reason why you have to buy the other strike is to get the difference in the premium for the actual spread itself. That's the only reason why it is. Now, we are doing this $1 strike wide compared to before we did $2 strike wide. Sorry. With the $1 strike wide, it's going to be $100 per contract. So if you buy one contract, it's $100 per contract. If you buy 10 contracts, it's $1,000 right there. So the premium now is $5 for this specific set of contracts. Okay. So for this specific set, you would make, for every contract you would open in this spread, in this call credit spread, you would make $5. So if I did 10 contracts, I would make $50. If I did one contract, I would make $5, obviously. And again, same rules apply. Sorry, I'm focusing on the 200% stop loss. If I am out, I am out. It is what it is. So a $10 loss, which means I would sell these over or at 0.15. I usually do it 1 cent higher. So for example, if I'm looking to make $5, I do it at 0.16 is where I might set my stop. So it would be like a 15% stop loss. I give it that 1 cent buffer, or that, next cent buffer over the 200%. Sorry for that. Okay. So now that that is explained, and hopefully that is easy, and I have this all written out too. I'll definitely write it out so you guys can see it visually in the video here, and you can see it in written form too with the examples. Let's go over a iron condor. So with an iron condor, this all settles on the focus of you want price to stay in between two certain levels. Okay, so let's do the same thing we did before. We're selling the 483s, buying the 481s. Let's go sell the 500s and buy the 502s. So across the board, $2 strike wide. Okay, so $200 per contract. Just because you have 4 of these doesn't mean it's $400 per contract. It is still $200 per contract to open the spread because you're doing it 2 strikes wide. Okay. Now, what's it called? Sorry. Lost a train of thought there. You could see the premiums for this is 0.26. So $26 per contract at a $200 per strike, buy-in. So my stop loss here would be 0.52 or $52. Again, I rounded up that 1 cent, $53. And if I bought 10 contracts, I would be at a $2,000, collateral risk. And if I bought those 10 contracts, I would be at a $260 profit. That would be a over 10% return on this trade specifically, doing this iron condor. And again, this is a strategy where the risk is technically higher and the profit is much lower. And again, I think that's where a lot of people overlook this strategy. And in the fact that I just don't think people truly understand it when it is truly so simple. And hopefully I've explained this as simple as I possibly can. Sorry if I, rambled and, went on. But again, make it quick and easy. Put spread, you want the stock or whatever you're trading to be stay above your sold price. Call spread, you want your price of that stock to stay below your sold strike. So you can see puts above, calls below. That's how you make profit. Iron Condor, you want it to stay in between the price. So you want it to stay in between these sold strikes. So for between 483 on QQQ and 500 on QQQ, if by the end of the day, if you're doing a same day contract, which I usually do, you will make profit if it stays in between that area. So you have a $17 buffer there, 43 to 500. Okay. On each side, that's about just say $8 and, $9. Okay. Again, that's about that 2% mark. One side is a little bit over the 2%. One side is a little bit under the 2% in this specific scenario. But that is how it works. It's as simple as that. I'm trying to think what else. So now let me go over my rules. Again, stop loss is a rule, that 200% stop loss. One of my biggest rules is I have to wait until 10:30 to even enter a spread. And there is so many different examples. If you go back months and look at all these days, there are so many different examples. If you enter the spread too early, you will have a higher chance of losing. Okay. This is a rule I found out after a year of trading this. I would enter too early and I would see that I could have got a much better entry, or I got in right before it looked like it was trending in one direction, and I got in right before a 10 or a 10:30 turnaround, and I would get killed. Those would be the trades that I would lose on. Again, this 10:30 to 11 rule is big. 10:30 Eastern to 11 a.m. Eastern is when I look to enter a trade. I do not enter any spreads before that. That is a big rule. The 200% stop loss is a big rule. You could do this on Qs, SPY, or IWM. I preferably only trade it on Qs. Again, I do same day contracts. You could definitely do it on SPY. It is the same type of scenario here. Sorry, I just wanted to see. It is the same type of scenario. Again, I focus on Qs. Other than that, I mean, that is basically it. I wanted to make this video as short as possible. Hopefully, it was as easy to understand. I try to explain it in a very simple way. I try to show, and I use Robinhood because I know a lot of people use it, and I actually personally love Robinhood for spreads. It's just so easy to use. As you can see here, you literally just click and you switch over and you click again. But this is a strategy I truly believe people should look into, especially if they had trouble just doing regular long calls, short puts. I highly suggest this. I would definitely look into it at least. I know a lot of people have been asking me about doing an education on this. And I've seen a lot of you who have started spreads over the past few months, and I absolutely love to see the progress you made. I know people that I've talked to over the years that have personally like only done spreads after they had troubles in the beginning, and they're doing really well on it. So that's really nice to hear and see, especially people that I talk to every day that have changed their lives from doing this and definitely turned around their trading careers. So it's one of the key strategies that I absolutely love and love to see people having success. Other than that, I believe that's it. If anyone has any questions, please do ask. Yes, all this is recorded, by the way.